welcome to today's edition of LendTech Live. Joining us today, Jeff Shood, CEO of Intuvo. Okay, let's talk about one of the key metrics to profitability for any loan officer, and that's all about the pull-through rate. So let's define what it means and talk a little bit about your company.
So pull-through is basically taking the number of applications that you have approved and then looking over a period of time of the number of people that actually close a loan with you. And it's a very, very important statistic right now.
Okay. Number one, go.
One, we're moving into a purchase market. Now, we all thought that refis would have been dead this year. Some very interesting things happened in the economy and refis kept going. But next year we know we're transitioning in 2018 into a purchase market. So it's very important to understand our metric of how many people we're bringing into the door, we have the eligibility to lend to, and then we're actually moving forward. What's really amazing is industry-wide, that number's only around 40% today. So that means
Wait a minute, 40% of applications close?
Correct.
Okay.
So I'm literally saying, on average, it costs $8,000 in hard costs to move somebody from application to closing.
Okay.
Of the people that you spend that money on, only 4 out of 10 will actually end up closing with you. And there's a number of reasons for this.
Let's go through those.
So in the community banking credit union space, one of the number one challenges that they have is what we call Realtor Redirection. So it's very common, especially on the Western Seaboard, Eastern Seaboard, where we're in very competitive markets, where you've got people who have got multiple offers, oftentimes cash buyers coming in. Just a few years ago, it took 90 days, maybe 120 days for somebody to identify they wanted to buy a home, find the home, and move in. Now, we're on an average of 9 months from the time somebody identifies they want to purchase a home to the time they find the house. And on average, people are making offers on 3.5 houses. Now, I don't know where the 0.5 house comes from,
right.
But maybe it's a shed they're getting for the backyard. I don't know what that is. But 3.5 offers that people are making at this point in time. So because of that, you've got a hyper-competitive market, and you've got a sales cycle that has expanded from just a couple of months to almost a year. Now, the problem with that is that there are a lot of opportunities for other institutions to take your borrower away from you.
Okay, let me break this down. Let's understand this. So if they have multiple offers, that means that people are coming to those offers saying, I'm pre-approved.
Yep.
So that's where the application starts.
That's correct.
As we're monitoring this metric.
Absolutely.
Okay, so because they might lose that deal or significant deals, that's what's in part contributing to this ratio that's way off.
It's a huge part of it because, for you as a loan officer, you've now already done 3 pre-approval letters for these last 3 offers, and then the borrower goes into this drought period where they're a little frustrated. They made 3 offers, they got outbid for the 3rd time by a cash buyer, and 4 months goes by. Then it's Saturday night, they finally found that place, the realtor's super excited about it, and he's like, look, we can't mess up on this one. I know that you're pre-approved with so-and-so lender over here, but look, my golfing buddy Steve, I can call him on my cell right now. He'll take care of us. He'll get us a pre-approval turned around tonight. Let me walk that in to go ahead and make that offer tomorrow on a Sunday afternoon. And that's where it all starts.
I would think that would be really bad just from a credit standpoint. From a borrower perspective, does that play into that?
No, so in mortgage lending, some of the regulations have changed of the number of times that you're allowed to pull credit, especially because of the market that we're in and how long people are going through the process. But it's such a common issue that they're up against. And so there's a number of strategies to go around this and to make sure that we're engaged with our borrower throughout the entire process. But most lenders are really focused on either feast or famine. Either I'm focusing right on the people in front of me and making sure that I'm getting those loans done, because we know that the process has gotten incredibly more complex in the past 24 months, or they're looking for that next deal. And they're not keeping their eye on those people that are 3 to 6 months out from closing something at some point in time.
Okay, so let's understand, through this pre-approval process, how much labor is that costing an organization?
So some recent numbers came out just this summer. On average, it costs a financial institution $8,000 from application to closing.
Okay. So
to get somebody through the initial pre-approval, most estimates are that in hard labor costs, LOS costs, credit pull costs, the income verification, you're looking at about $2,000 in hard costs.
So without any commitment from that buyer, you're $2,000 in the hole.
And if 6 out of 10 of them are going somewhere else, that money very quickly adds up to your institution.
Okay, now that we understand the problem, because that's an expensive problem.
It's a very expensive. In fact, another statistic was just released this year. Over 65% of mortgage banks in 2017 are expected to not be profitable. And this is one of those reasons.
Wow. Okay. So, do we beyond the pre-approval conundrum? Well, let's just call it that, for lack of a better term. What other bottlenecks would prevent a loan from closing?
So there's a number of things. One, timing to offers, of course, and so the ability to gather documents quickly, do automated approvals as fast as you can, and basically deal with very finicky borrowers who are in a major hurry to do very fast negotiations. So the keys to that are having a great online platform where somebody can immediately get pre-approval online without talking to a loan officer. Automated verifications and being able to move the documents through faster to get to that pre-approval letter.
There's no labor.
There's no labor involved in that.
Okay.
If you've got the right automated system.
Got it. So that's just the cost of technology, which I would see as an investment.
A major investment.
Okay.
And I think one that it used to be something that you did to try to improve your hard costs. Today, it's just a competitive necessity. If you don't have an online portal where a member or a borrower can come in, get pre-approved, and do that all online without working with a human, do it 24 hours a day, you're not competitive anymore.
Okay, and so then how much of that, let's say the 60%, is attributed to just plain bad processes or laziness or inefficiencies?
It's actually not as much as you think. From what we've seen and just anecdotal talking to customers, it's really only 10 or 15% of it.
That's a lot.
Yeah, but the bigger chunk of it is really just not staying in touch, and most importantly, creating that initial great borrower experience from the beginning to make sure that they know that you're a trusted advisor and you're going to be walking them through every step of the way. You'd be surprised how many loan officers forget the basics. Within 24 hours of somebody getting approved for a loan, either online or with that loan officer, immediately reach out, make sure they know how to get a hold of you 24 hours a day, and set expectations for what the process is going to look like, especially with first-time home buyers and millennials that are really green to understanding this process.
Yes.
That I think we take for granted as mortgage professionals, how complex it actually is to the average person. And
it feels like if borrowers are fickle that they might, on a different deal, go to another lender, the seeding that relationship in those early stages is critical to that loyalty.
Is incredibly important. And with first-time home buyers, it's all about education and walking them through the process and setting realistic expectations. With more sophisticated borrowers like investors, it's all about your technology processes, the ability to get documents to them fast, and to provide digital updates.
I love it. Now let's talk about Intuvo and how you guys solve these little gaps in the process. So let's talk a little bit about your model.
Absolutely. So our vision is really straightforward. We want to help financial institutions understand the individual needs of all their borrowers and then respond with very personalized messaging. So the way we implement that is we have a marketing automation and CRM platform, synchronizes with the loan origination platform, and then is monitoring all the activities happening with that borrower, whether they're somebody who came in online and aren't yet ready to apply, there's somebody who maybe abandoned an application, or this is the fourth loan they've ever done, they're an investor and they're very comfortable with the process. From there, we determine that type of follow-up that needs to happen, whether it be educational, updates on their loan, and automate the entire process, create prompts for the loan officer, send mobile messages via text or a mobile app, and really create that perfect borrower experience.
I love this because having bought and sold real estate myself, I don't like the fact that it might be 4 or 5 days before I get a phone call that says your close has been delayed because we don't have this document. It's just like, when did you know about this? And it took you this many days to call me.
Absolutely.
Right? So you're saying that these push notifications would help everybody just understand where they are on the chessboard.
It's massive. I've been in the mortgage technology space for about 12 years now. I recently bought my dream home and bought it through a lender that I've known for 15-something years, and I was still on pins and needles the entire time. It is an incredibly stressful process. And making sure that you're giving people updates, and just as importantly, setting expectations of what's going to be happening next is the key to having a very engaged and very comfortable borrower.
Setting expectations and managing expectations.
Absolutely.
That's the difference between loyalty and not.
Absolutely.
I love that. Okay, so this is fantastic. I love this because one of the things that we're all trying to solve for is how is it that we build a great relationship so that in 5 to 7 years when they're upgrading their home or downgrading, they're thinking about you. How is it that you maintain a relationship, not just through the process, but really for the long haul of business? And getting referral business would be huge.
Yep, absolutely.
And this high touch part is, I just think, the value of picking up the phone and calling somebody and touching base is enormous.
Absolutely, and I think one of the keys to it is being very targeted in your timing that you're doing it. So, you know, we all open up our Gmail in the morning and we've got 100-something spam messages, no matter how great the spam filters are, and it's very tough to weed through the right message. Pay-per-click advertising and digital tracking is just everywhere now, and you're constantly bombarded with messaging. So I believe one of the goals that every lender should have is to understand when they should reach out to a borrower and what type of message to give them at the right time. So that involves tracking a lot of things. You know, using the data you get from your LOS, you can track things like, obviously, when somebody can potentially refinance. You can also look at the ages of their children and understand when their kids are going to be going away to college, and talk about college education and financing that you can do, and how their home equity can come into play with that, as well as look at other types of data based on their accounts and determine things like when they may be moving up and when they may be moving down in their home, and really fine-tuning your message so that you're reaching the person with that right message at the right time.
I love that, because now you can diversify them into more products.
Exactly.
I love this. So the other key thing that I'm hearing is just through this sense of urgency with loan closing. I'm very reluctant to give my mobile out and to authorize push notifications. But I would think with your technology, people would readily give you that permission, just so you've got real-time access and not getting buried in the inbox.
You know, when you think about it, your loan officer knows more about you than your doctor does. It's a really funny fact.
They probably know more about me than I do.
That's probably true. I mean, when you think about the amount of information that you've got to give, they know absolutely everything. And once that level of trust is built, I think people are very comfortable with that, because they recognize the gravity of the situation that they're in and just how big of a purchase that they're making. So I think it's very important that lenders create that trust on a personal level very quickly, show that from a technology standpoint that their data is safe, and then all the data that we're seeing is people are very comfortable receiving that type of information. In fact, a study was just put out in spring of this year. 62% of home buyers would actually prefer a text message than a phone call.
I'm one of those people.
Probably.
I would absolutely invite that.
You're in a meeting, you're at the office. I mean, how many people really have the time to grab a phone call from a number they don't recognize?
Yeah, no, this is big. So the name of the game in any sort of campaign is segmentation and personalization.
Absolutely.
Right? So anytime that we understand the borrower with such granularity that we can now start to position them with messages that are relevant to where they are in that space and time, that's gold for any organization and a great investment in the future.
Absolutely.
Jeff, you are amazing.
Well, thank you so much. This was a great time.
We appreciate you bringing your insights to our audience. Join us again for the next edition of LendTech Live, where we will be exploring the big dividends of increasing your profits in loan processing. Thanks for joining us.